Good day everyone, this is Grace Joy Misoles and today I will be discussing the monthly exercises 2. So we are given the audit of the accounts of Carkits Corporation for the year ended December 31, 2018. That has been completed by the staff of Go and Associates CPAs. So shown below are the unaudited trial balance and certain additional information pertaining thereto appearing in the working papers. So we are required to prepare a list of audit adjusting entries, prepare a one-section trial balance, and lastly to compute the correct balance of the following. So we are required to prepare a list of audit adjusting entries for the additional informations. So number 1, account of petty cash fund on January 2, 2019 showed its composition as follows. Currency and coins 6,000, petty cash vouchers all dated 2018 except for 1,500 which pertains to 2019, 6,000. Employees post-dated checked 3,000 and that totals for 15,000. So our entry would be debit advances to officers and employees 3,000, debit marketing and administrative expenses 4,500, and credit petty cash fund 7,500. So number 2, we have the following reconciling items for December 31, 2018. So A, customers' checks returned by the bank marked DAIF in December 2018 redeposited in January 2019, 35,000. So ang DAIF, that means drawn against insufficient funds. So buta-sabutan ni kanang Y kwarta ang imong account to cover a check. So clearly akit ni siya. So B, a bank credit memo representing collection by the bank from one of the company's major customers 40,000. So again included for adjustment. Next, C and D. So both are reconciling items for bank balance and not for book balance. So dili ni sila included. And then lastly, E, the company wrote several checks at the end of 2018 for accounts payable that were held and not mailed until January 15, 2019. This totaled to 48,300 and were included in the outstanding checks of December 31, 2018. So include this sa atong adjusting entries for it justifies a payment check for an accounts payable. So for our problem 2, our entry would be for A, debit accounts receivable 35,000 and credit cash in bank 35,000. For B, cash in bank debit 40,000 and credit accounts receivable 40,000. And for E, debit cash in bank 48,300 and credit accounts payable 48,300. So the third problem is the trading securities portfolio of Carkits Corporation contain the securities listed below. So trading securities are securities that have been purchased by the company for the purpose of realizing a short-term profit. So the issuing company creates these instruments for the express purpose of raising funds to further finance business activities and expansion. So, trading securities are treated using the fair value method, whereby the value of the securities on the company's balance sheet is equivalent to their current market value. So below are the securities listed by Smart Corporation ordinary shares for a cost of 70,000 and a fair value for 2017 is 30,000 and for 2018 is 40,000. Next is Globe Corporation ordinary shares, which is the cost is 100,000 and its fair value for 2017 is 120,000 and for 2018 we have 150,000. And lastly, Nokia Company ordinary shares for a cost of 210,000 and its fair value for 2017 is 180,000 and for 2018 is 160,000. So the total for cost is 380,000 and for its fair value the total for 2017 is 330,000 and for December 31, 2018 we have 350,000. So we can see that we have an increase of 20,000 for 2018 for its fair value. So our entry would be debit trading securities 20,000 and credit unrealized gain on trading securities 20,000. Number 4 problem is the audit revealed that accounts receivable was composed of the following: customers accounts 2,799,000, advances to officers and employees 120,000, selling price of merchandise 625,000, which totals to 3,544,000. So our entry would be debit advances to officers and employees 120,000 and credit accounts receivable 120,000. Next problem. Physical inventory of merchandise as of December 31, 2018 amounted to 4,398,900. So the following information has been found relating to certain inventory transactions. So A. 35,000 shipment of goods to customers on December 31, 2018. Terms FOB destination was not included in the year-end inventory. The goods cost 26,000 and were received by the customer on January 8, 2019. The sale was properly recorded in 2019. So our entry would be debit inventories 26,000 and credit cost of goods sold 26,000. Next, B. An invoice for goods costing 35,000 was received and recorded as a purchase on December 31, 2018. The related goods shipped FOB destination were received on January 2, 2019 and thus were not included in the physical inventory. So our entry would be debit accounts payable 35,000 and credit cost of goods sold 35,000. So next, C. Goods costing 27,000 were received from a vendor on January 5, 2019. The related invoice was received and recorded on January 12, 2019. The goods were shipped on December 31, 2018. Terms FOB shipping point. So our entry would be debit inventories 27,000, credit accounts payable 27,000. So next, the inventory cut-offs test indicate that 22,350 of inventory received on December 30, 2018 was recorded as purchases and accounts payable on 2019. These items were included in the inventory count at year end. So our entry would be debit cost of goods sold 22,350 and credit accounts payable 22,350. And lastly, for 5E, inventory cut-off test indicates several sales invoices recorded in 2018 for goods that were shipped in early 2019. The goods were not included in inventory but were set aside in separate shipping area. The total amount of these shipments was 36,000. Cost is 25,000. So our entry would be debit sales 36,000, debit inventories 25,000, credit accounts receivable 36,000, and credit cost of goods sold 25,000. So next is our sixth problem. The prepaid insurance account contains the premium cost of two policies. So policy A, cost of 13,200, 2-year taken on September 1, 2018. And policy B, cost of 16,200, 3-year term taken on April 1, 2018. So for the overall solution for number 6, for policy A, we need to divide the 13,200 to its year, to its term. So for policy A, we have 2-year term, and it is taken for September of 2018. So our solution for policy A would be 13,200 divided by 2, our term, times 4/12 is equal to 2,200. And for B, 16,200 divided by our term, which is 3-year term, times 9/12 is equal to 4,050. And that totals to 6,250. So our entry would be debit marketing and administrative expense 6,250 and credit prepaid insurance 6,250. 7. The property, plant, and equipment account of the company is composed of the following. So land and building 8,600,000, furniture and fixtures 2,177,000, leasehold improvements 168,000, which totals to 10,945,000. So at the beginning of 2018, the company purchased land and building for 8,600,000, which include 180,000 of realty tax in arrears of prior years. A mortgage of 2 million was assumed by the company on the purchase. 20% of the purchase price should be allocated to the land and the balance to the building. So in order to make the building suitable for the use of the company, remodeling costs in the amount of 900,000 were incurred, and This was charged to repairs and maintenance expense. Such remodeling necessitates demolition of a portion of building, which resulted in recovery of salvage materials sold for 30,000 cash and recorded as scrap income. No depreciation was been recognized on the building for 2018, which has an estimated useful life of 50 years and salvage value of 250,000. On May 1, 2018, cost of 168,000 were incurred to improve leased office premises. The leasehold improvements have a useful life of 8 years. The related lease, which terminates on December 31, 2024, is renewable for an additional 6 term. No depreciation has been recorded yet on the leasehold improvements of 2018. So, our first entry would be debit land 1,864,000, building 7,606,000, and debit other income 30,000, and credit land and building 8,600,000, and credit marketing and administrative expense 900,000. And our second entry would be debit marketing and administrative expense 166,800, credit accumulated depreciation building 150,000, and credit accumulated depreciation leasehold improvements 16,800. So next, our eighth problem. A franchise agreement was acquired at the beginning of 2018 for 500,000. No amortization has been recorded for 2018. A 10-year amortization period is to be used. So our entry would be debit marketing and administrative expense 50,000 and accumulated amortization franchise 50,000. So our next problem, 9. The company licensing agreement account has a balance of 216,000. Original amount was 360,000 and is being amortized on a 5-year basis starting on January 2016 as of year-end amortization has not been recorded. So our entry for 9 would be debit marketing administrative expense 72,000, licensing agreement debit 144,000, and credit accumulated amortization licensing agreement 216,000. Our next problem, you were furnished with the schedule of accounts payable and accrued interest as of December 31, 2018. Your verification disclosed the following. For A, payment to the Leon Company, a supplier amounting to 126,000, was erroneously debited to the account of the Leon Corporation, another supplier. So our entry for A, debit accounts payable Delon 126,000 and accounts payable credit 126,000. For B, the following unpaid vouchers has been recorded as the year end. So first, light, telephone, and water bills for December totaling 22,800. Property taxes for last quarter of 2018 due on first week of January 2019, 100,000. And lastly, various payroll taxes, 18,000. So our entry would be debit marketing and administrative expense 50,800 and credit accrued expense 50,800. Next problem. The rent was received from a tenant in December 2018 The amount of 130,000 was recorded as income at the time even though the rental pertains to 2019. So our entry would be debit other income 130,000 and credit unearned revenue 130,000. 12th problem is the mortgage on land and building assumed by company is payable in installment of 500,000 every January 1 starting January 1, 2019. Interest of 20% per annum is payable semi-annually every January 1 and July 1. So our first entry for 12 is debit interest expense 200,000 and credit interest payable 200,000. Our second entry would be mortgage payable of 500,000 and credit current portion of long-term debt 500,000. So our 13th problem, the bonds payable represented a 9% 2 million face value bonds which were issued on January 1, 2014 to yield 10%. Interest is payable annually on January 1. No interest accrual nor bonds discount amortization was recorded during 2018. So our entry would be debit interest expense 187,800, credit interest payable 180,000, and credit discount on bonds payable 7,800. Last problem, the company is subject to 30% income tax rate. So our entry would be income tax payable 127,126 and credit income tax expense 127,126. We will now proceed to the next requirement, which is to prepare a one-section trial balance. So flash on the screen is our working trial balance for Carkets Corporation for the year ended December 31, 2018. So for the trial balance, it is where it is shown katong-atong unadjusted ganina, and then gibutang na nato diri ang atong adjustments. Katong-atong adjustments ganina gibuhat sa additional informations. So dili na tag sa tagsaon, pareha aning kaning sa petty cash fund. So ang atong adjustment ani ganina, sa katong number 1 is katong advances to employees, marketing and administrative expense. Ang atong adjustment is ang petty cash fund is amounting for a credit balance of 7,500. So sa atong working trial balance, atong adjustment mo tong sa petty cash fund mo tong 7,500. Sa working trial balance, di na lang nahatag sa tagsaon. Since sa third requirement sa computation, makita mo gud nato nga nung income up ta ato nga kanang sa katong adjustments. Our next requirement would be the computation of the following. So first is ang petty cash fund. Initial balance 15,000 less sa atong adjustment which is 7,500. So ang atong final balance for petty cash fund would be 7,500. Next, cash in bank, initial balance of 243,600 and add accumulated adjustments 53,300. And next, that totals to our final balance would be 296,900. So next, trading securities. Our initial balance is 330,000. Add accumulated adjustment, which is 20,000. So our final balance would be 350,000. Fourth, accounts receivable. Initial balance of 3,544,000 less accumulated adjustments 786,000. That comes up to our total 2,758,000. Next, allowance for doubtful accounts. Our initial balance would be 128,000. Add accumulated adjustments 17,900, and our final balance would be 137,900. Sixth, advances from officers and employees. Initial balance 0. Add accumulated adjustments, which is 123,000, so our total would be 128,000. Seventh, inventories. Beginning inventory is 4,398,900. Add accumulated adjustments 578,000, so our ending inventory would be 4,976,000. 8. Prepaid insurance. Our initial balance is 29,400 less accumulated adjustments 6,250, so our final balance would be 23,150. So 9. Land. Our initial balance of land and building is 8,600,000 multiplied by the 20% part designated to the land. So our final balance for the land will be 1,720,000. 10th, building. So our initial balance is 8,600,000 multiplied by 80% part designated to the building. So our total would be 6,880,000. Add by our remodeling cost 900,000 and less scrap income 30,000. That totals to our balance of the building 7,750,000. 11th, accumulated depreciation building. Initial balance 0. Add accumulated depreciation for building 150,000, and our final balance for accumulated depreciation building would be 150,000. So carrying amount of leasehold improvements. Initial balance leasehold improvements is 168,000 less accumulated depreciation leasehold improvements 16,800. So our carrying value leasehold improvements would be 150,000. Next, 13, franchise. Initial balance is 500,000 less accumulated amortization 50,000, and our carrying amount franchise will be 450,000. 14th, carrying amount of licensing agreements 360,000 less accumulated amortization licensing agreements 216,000. So our carrying value licensing agreements would be 144,000. So 15th, accounts payable. Initial balance 2,141,550. Added accumulated adjustment 62,650. So our final balance would be 2,204,200. Accrued operating expense. Initial balance is 598,020. Add accumulated adjustment, which is 50,800. That makes our final balance 648,820. So 17th, unearned revenues. Initial balance 0. Accumulated adjustment is 130. Final balance would be 130. So 18th, interest payable. Initial balance of 0. Add our adjustment is 380. That makes our final balance 380,000. So next, income tax payable. Initial balance 193,300. 365 less our adjustment 127,126. That makes our final balance 66,239. Next, dividends payable. Our initial balance is 0. Our add by our accumulated adjustment 1,250,000. That makes our final balance 1,250,000. So 21, current portion of long-term debt, initial balance 0, accumulated adjustment 500,000. So that makes our final balance 500,000. 22, discount on bonds payable, initial balance 122,000, less accumulated adjustment 7,800. That makes our final balance 114,200. So 23, ordinary short capital, initial balance 5 million. Our retained earnings, initial balance is 2,867,840. So 25th, sales, initial balance is 250,000, less accumulated adjustment 661,000. That makes our final balance 31,589. So 26th, cost of goods sold, initial balance is 18,169,950, less accumulated depreciation 563,650. That makes our final balance 17,606,300. 27th, marketing and administration expenses, initial balances is 8,900,400, less accumulated depreciation of 531,750. That makes our final balance 8,368,650. 28, other income, initial balance 180,000, less accumulated adjustment 160,000. That makes our other income final balance 20,000. Next, interest income, initial balance is 404,320, add accumulated adjustments of 387,800. That makes our final balance 792,120. So lastly, profit. Sales 31,589,000. Cost of goods sold 17,606,300. Gross profit 13,982,700. Other income 20,000. That makes our total income 15,002,700. So our marketing administrative expense 8,363,650, and our income before interest and taxes 5,634,050. Our interest expense 792,120. So our profit before tax is 4,841,930, and our income tax, which is the 30% of 4,841,930, is 1,452,579. So to sum up, our profit would be 3,389,351. So that ends my report. Thank you for watching, and God bless.